You entered a trade, exited a trade, booked 2000 rupees in profit. But after that, the stock flew like Diwali crackers. And what are you left with? A small profit and a lot of regret. So in this video, let's talk about how to exit your trades without regret. Hi, I am Pranav K, an NISM-certified trader and trainer and your trading buddy here at Stockshaala by Kotak Securities. Today, we are discussing something that most traders get wrong: how to exit a trade. Because let's face it, entering is easy, but exiting is when the emotions explode. Let's be real, most exits fall into one of these traps. I just saw a red candle after such a big move, I think it's going to crash, let me exit. Or my neighbor's friend exited his trade, so let me also exit. Or it is going too well, so I panicked and booked a profit. Imagine quitting your job just because the coffee was tasting bad in the cafeteria. That's exactly how we exit trades sometimes. So let me help you break down 3 types of exits. You can use them individually or you can even combine them together. The first one is target-based exit. The second one is trailing stop losses. The third is structure-based exits. Let's decode each of them one by one. The first one is target-based exits. This is where you're going to set a target even before you enter into the trade. You decide what your stop loss is going to be and what your target is going to be. For example, let's say your stop loss is 100 rupees from your entry price. Then your target can be 100 rupees from your entry price or even 200 rupees from your entry price. If it is 100 rupees, then it is going to be a 1:1 risk to reward ratio. But if it is 200 rupees, then it is going to be a 1:2 risk to reward ratio. This works best when you're trading setups with defined structure. This is ideal for beginners, intraday traders, and people with high volume setups. The advantage of this kind of exit is that you are very clear and have clarity about your entire trading exit. But however, the risk is that sometimes you might miss out on big moves. The second type of exit that you can follow is the trailing stop loss. You trail your stop losses as and when the price starts moving higher and higher. Let's take for example, you're buying a stock at 100 rupees and your stop loss is right now at 90 rupees. As and when the price goes to 105, you're also going to push your stop loss by 5 rupees. This way, you're pushing your stop loss as and when the price moves higher and higher. This way, you're going to reduce the risk on your specific trade, and this is called trailing stop loss. The trailing stop loss can be manual or it can also be indicator based, which means as and when the indicator starts moving higher and higher, you shift your stop losses based on that specific indicator. Advantage of using this kind of exit is that you're going to stay in stronger trends. But however, the risk is that you might get stopped out during pullbacks. The third type of exit is a structure-based exit. You exit based on a specific price structure. It could be double tops or double bottoms, head and shoulder patterns, or it could be trendline breaks, or it could be rising or falling wedges as well. This is ideal for swing traders as well as position builders. The advantage of this kind of exit is that you have a high context, but on the other side, the risk is that you need very high skill to read the charts. While there are 3 different types of exits, what's more important is that which one is right for you. And to know that, ask yourself these 3 questions. Number 1, are you a short-term trader or a long-term trader? Number 2, are you looking for certainty or are you looking for flexibility? And number 3, are you okay with missing profits or missing out on trends? Exiting a trade is like leaving a party. Some people leave it too soon and miss all the fun, whereas some people stay till late and also clean the mess. So pick the one that suits your personality. Now you might be wondering that I told you that you can combine exits. So how do you do that? Here's what pros do. They book 50% of the profits when they reach the target. And for the remaining 50% of their positions, they trail their stop losses. And that's how you can combine your exit through a target and trailing stop losses together. It's like eating half the cake now and keeping the remaining half in the fridge for later. So here's what we have learned so far. Exits are very important and most times they are emotionally driven. So it's important for us to have data-driven exits. So what are the three types of exits one can have? The first one is based on target, the second one is trailing stop loss, and the third one is using structure. Using hybrid exits allows you to get the best of both worlds, where you're using exit through a target as well as trailing stop loss. Just like the pros do, book 50% earlier when you reach the target and leave the remaining 50% by trailing your stop losses. And finally, know your reason when you click on the exit button. Profits booked is peace earned, but regret-free profits, that's traders nirvana. In the next video, we are flipping the coin. We're going to talk about stop loss, how to protect your capital and make sure that you're not going to self-sabotage. Like this video if it made you feel that exits are a little less painful, and share it with your friends. You're watching Stockshaala by Kotak Securities and I am Pranav K signing off.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.